And the way that I met Derrick was, I had a client who had insurance with, who did Ron have insurance with?
It was one of the name brands. Allstate, I think.
Yeah. Yeah, it was Allstate. Okay. Anybody use Allstate insurance? I used it too. Excuse me. And what we found was that when you work with State Farm or Allstate or Geico, those companies really only have one kind of landlord policy. And so if they say to you, well, you'll save by bundling, that's a good thing. The bad thing is they only have one kind of landlord insurance policy. And that policy will have things that they'll pay for and things that they won't. And so what we found was we had investors who didn't realize there wasn't a theft rider on their insurance policy. So they had copper stolen from their houses and it wasn't paid. We had investors who didn't realize what the insurance company classified as an abandoned property. And so they didn't have the money to fix up a house in between tenants. It was classified as abandoned by their insurance company. It burned down and they didn't get paid. Now, there was no dishonesty on the part of those other companies. But we had clients getting insurance policies that they didn't understand the fine print. So we thought, we need to stop just using bundling or using our friend because our kids played basketball together. And why not use an insurance broker just like you would use a mortgage broker? Because an insurance broker isn't aligned with any one company, are they? They have how many companies that you can write for?
Well, we haven't counted recently. We stopped at, we represent over 400 insurers, so we stopped counting at that point.
Yeah, so 400 insurers, each with their own set of policies.
Correct.
Now, one of the things that I find that investors don't understand is when you're building your team, who needs to be local and who can be national? Title companies, local or national? Local, good. Derrick, insurance, local or national?
Depends on the agent, but with us, it's national.
With you, it's national. How many states can you write in?
All of them.
So I have, if I buy a property in the lower 48, Derrick covers it for me.
Even in that upper and other lower one.
Do we? I'm all 50. Yeah, question. Oh, in Canada? I'm not covered yet in Canada, am I?
Well, yes and no. Canada's tough because they have restrictive licensing. You have to go through a Canadian broker to get access to the Canadian market. So, yes, we can because we have an aligned Canadian broker, but it's yet another step, so it takes a little bit longer.
Lawyers, local or national? Why? They got to pass a state bar. Accountants, local or national? National. National. The accountant that I use in Idaho, lives in Utah, files for all the states that I do business in. And the main reason I use him is because he was an auditor for IRS for 8 years. That'd be pretty nice for your accountant? He's like, oh, no, they don't look at that. I'll call my buddy Jeff. He said, they don't check that out right now. We're fine on that. Okay, you call it, bro. I get audited. You're going to the audit. So we'll circle back on accounting. Banks, local or national? I used to believe national because I thought it would be good to have ATMs everywhere, and I do not believe that anymore. I'm a local bank guy. Let me tell you why. Local banks can give you properties. National banks will laugh at you unless you have $200 million. Local banks can give you non-recourse loans. National banks will laugh at you. Local banks can give you lines of credit. Local banks want your business. JP Morgan Chase does not want your business unless you do over $25 million a year in business. They flat out told me that. Okay? They don't even want your business. Local banks do, because they actually make money from your account. People are like, they charge me those fees and that. Chase doesn't care about that. They make money on more from Wall Street relationships than they ever do from your little checking account fees. They don't care. They just do it because they have to. They see that as a loss leader. Does that make sense? I didn't understand all that, but we moved all of our banking from Chase to a local regional Huntington bank that's just in Ohio, Indiana, and one other state, Michigan, because they wanted our business. We have a personal banker that works with us. I mean, we have this it was even funnier. Anybody notice that Chase has been getting fined billions of dollars for their international suspicious banking? They came to us and they said, hey, these investors that you have in Singapore that you're wiring rent money to, we don't like that relationship. Tell them they have to get accounts somewhere else. I said, okay, if I have to take them, then we're all going. And so we left, and they're like, we don't care. Huntington's like, we love this business, thank you. They're sending key fobs over to Singapore for our investors to log in. So I'm a local bank guy now too, for sure. As I think of more, I'll throw him up there. But what I love about Derrick is that he's a third-generation owner of an insurance brokerage. I think you should only use insurance brokers. Now, I told them earlier about the pre-rehab props, how they can stay on my policy until it's rehabbed, and then we'll just invoice them for it. I also told them that we have a pretty standard policy that as they buy, because we've probably sold 20, 25 properties this weekend, that they can activate. I told them that if they don't get signed up for insurance, like our investor in Singapore, then they're screwed. There's nothing you can do to help them. The last thing I want to touch base on, because the thing about Derrick is, just like I am fluent in Spanish, Derrick is fluent in insurance.
It is a language almost.
It absolutely is. He is fluent in insurance, and I have learned over the years that as long as I am very explicit with Derrick, tell him what I need, tell him what I need help with, I have never had an issue with the policies that he's provided. And how do you know when you have an issue? When you make claims. And as I've had claims come up over the year, that's when you know what kind of insurance you have. And we have excellent insurance with Derrick. I trust Derrick. He is good, and he's always taken care of me. Now, one quick thing that I find that investors don't understand is the difference between actual cash value and replacement cost.
And one thing I always like to point out, if you notice, when you guys buy or sell houses, you buy or sell at market value. In insurance, we didn't use the word market value anywhere in there.
Yeah, isn't that interesting? Yeah, we say market value, they say.
Well, it's not even actual cash value mimics it, but not really. It's not really market value.
So you see how you can start to get complicated? So, on the house that I live in, I do replacement costs because if it burns down, I want to replace it. On my rental properties, because I get 40% discount on my construction, and you get that as well, I usually like for you to get actual cash value. Most of the time, your actual cash value policy will be cheaper than replacement cost. But that's not the motivation. It's just because you have access to my cheap construction. So that if something happens and you have to make a claim, there will be enough money to repair the property or walk away. Because I can get you more deals, the perfect scenario is like what I was talking about yesterday. House burns down, you get a check, it covers your investment, and I buy you another property. Make sense? That has happened many times for us. Never on purpose. Okay, so that's my Cliff Notes summary of what I personally think, what my advice is. Okay? We have investors that after going through their personal discussion with Derrick, make the decision to get replacement cost on their rental properties. I don't care. I just want you to understand why you're doing it. And if you decide to do it different from me, that you have a good reason for that. Does that make sense? Is that fair? That's the only reason I give you the Cliff Notes, not because I want you to follow me. I just want you to be educated and have clarity. Because it doesn't make it easier to go, okay, well, I know that Aaron likes that on his house and that on his rentals. Now let me listen to Derrick and see what Derrick says. Makes it it's kind of an easier educational point of reference. He can't say that because he's a broker and he's licensed and he doesn't direct people to certain policies. I do because I'm just an investor and I have no I have no licensing obligation to do that. I can say I like this better than this. If you do that, then that's a liability issue. So does that make sense? Okay, so I'm gonna let him take a few minutes and really kind of go through insurance and answer your questions about it, and we'll just roll from there.
Yeah, as Aaron was talking about, me being a licensed insurance broker, I do have to just kind of give a non-biased opinion on what you're choosing. So with actually my favorite story on that is one time I just had to talk to this person. It was just one of those things in business that I needed to give them a call and talk to them. They were suing the insurance company, not me, but I needed to call him. So talk to my attorney. He's suing the insurance company. Should I call him? He goes, my legal opinion, absolutely not. But yeah, I understand exactly why you have to call him. So that's kind of how my advice works is, I have to tell you the non-biased fact, but I understand if you go any which way with your insurance. That's just my job, is to advise you, not to pick for you. Well, I guess that's about me there. This talks a little bit about our agency. Started, as he said, I'm third generation, started in 1958. That number is changed on the 400 different markets. We have many more than that, but just we quit counting at some point. All U.S. jurisdictions, even Puerto Rico, Guam, all those fun places. Haven't wrote a policy in any of those. They're just hanging out there. So if you find one, I'd love to have that write-off for the inspection that I have to do. And then highly automated, we of course have, everybody has 24/7 policy view, things like that. I always like to start my discussion off with just a little bit about what type of, and I say agent, but I really mean what kind of advisor do you want? And there's two different regular advisors in the world. There's the bartender, and then there's the personal trainer. We all know the bartender. You walk in, you belly up, you say, I want this. He slides it to you. He gives you a smile, and when you want another one, he gives it to you with a smile again. That's really good if you know exactly what you want. If you know exactly what insurance policy, if you know exactly how to do taxes, go find that bartender. They'll offload the work from you. They'll open that bottle for you. Go there. Personal trainer, they're going to give you the hard truth. You're going to have your ideas on where you're at and where you want to be, and he's going to tell you, no, I know you think that walking around the block a couple times is going to do it, but you really need to do this. And they're going to push you, and they're going to get you the result, but you may not be too happy about them in the process. I'll try to, hopefully your advisor can also keep you happy, but sometimes you have to hear that truth from them that, hey, that I know you think it goes that way, but that's not necessarily the way it goes. The second part I like to do is just when I get that phone call from the panic investor that went someplace else and they go, my claim was not covered, these are the things that we see happen. One of the big ones if you go to your personal insurer is this first one, who is covered. A lot of you are going to start self-directed IRAs, LLCs, everything else like that. A lot of these personal insurers will not insure in anything but your personal name. They'll say, oh, we'll additionally insure your LLC, we'll additionally insure the self-directed IRA, but is that coverage really there? When you get down into the policy, it may or may not be in there if the top name doesn't match who's titled on the property. So names are free to add too. So if you have a self-directed IRA for 40% and an LLC for 20% and then you're individually involved for the other part, we can add all the names on. They don't charge you per name in insurance. We just want to make sure that you're insured correctly. What is covered? That detached garage that was on the property that you care deeply about, it ended up on the policy that they had. It wasn't covered, or the fence, or different things like that. Just have that discussion with your insurance broker. I want to make sure that this is covered and this is covered, because if you don't, they may just assume when you say, I want the house covered, they may just assume that you only want the house covered. Where is covered? We actually see this more than we should. Do double check their proposals, do double check their applications. Typos happen, but sometimes you even made the typo and they're just following along. So location, location, location. Make sure we have the right address, any insurer that you use. When do you need coverage? We can't read minds, so when you call and say, I need coverage, and you sign an application and we have the underwriter issue a policy, and everything along those lines, that's when we assume you need it. Then we'll get that call 3 weeks later, hey, we're getting ready to close. Can you move the date? Well, some underwriters will gladly do it. They don't care. They'll do it in 2 seconds. Some underwriters say, no, we will never move that date. If they want to cancel that policy, that's fine, but we're not going to move it to 3 weeks. It just depends on the underwriter. Again, just open communication that really helps us get it done. And then how is it covered? Replacement costs, actual cash value. Aaron very briefly went over those, and we'll go over them a little bit more. There's another one that's out there. You'll see it. It's called functional value. Functional value is when you give all the reconstruction ideas, all the reconstruction designs, everything, you give that over to the adjuster. He gets to pick exactly how your house is rebuilt as long as it replaces the function and gets to use the cheapest method possible. If you see functional value, I suggest running away because you're giving your control to another party. You may be fine with it. It may save you the money. It may make a business decision. I just suggest that you walk away from functional value if you can. This is the difference between replacement cost and actual cash value. Replacement cost is, as it sounds, the cost to replace. So we're going to insure the house, the cost that we estimate it would cost to replace the whole house. So you might buy a $60,000 house that we come back and say it's going to cost $180,000 to rebuild. And that's just because of square footage. To build something new in Indiana, it's about $90 to $100 per square foot. Well, if you find a 1,800 square foot house for $60,000, that's going to be about $180,000 to replace. We can't change that. We can't go back to 1922 and rebuild at their cost. We have to build here in 2014 if something burns down in 2014. One way to think of it is contractor invoice. By that I mean when we talk replacement costs, so there's a hailstorm that happens to the house. Those do happen here in Indianapolis. The contractor goes out and goes, there's certainly hail damage. It's going to cost $10,000. What he's speaking in right there is replacement cost. So just kind of keep that held, that whenever he says that, that's the cost to replace or rebuild. Receive full contract. So when that claim happens, that $10,000 hailstorm happens, we subtract our deductible on replacement costs and write the difference. So if it's a $1,000 deductible, you receive a $9,000 check and move on. Actual cash value, the full description in the policy is replacement cost minus depreciation. Think of it as a logical market value. Market value is never logical. It's just what two people agree a property is worth. So that's why we have a different word called actual cash value. It's replacement cost minus depreciation, and we mean depreciation on the house in whole. So roof's always a good example. You have that roof, they were 20-year shingles. It was on there for 25 years. It needed to be replaced. That hailstorm comes by, you're probably getting close to zero. That roof needed to be replaced 5 years ago. You know, when we take replacement costs and subtract out the depreciation, probably not a lot of payment there. To the opposite, that roof was replaced yesterday and the hailstorm occurs today, you're probably getting pretty darn close to replacement costs because it has not depreciated much. So actual cash value is a moving type of target. That's the one thing that when I have investors that choose replacement cost, it's because of that. They don't like that moving target. They want to know exactly what's there. Just their risk tolerance is lower. You'll receive full market value when the claim occurs. By that, what I meant by that up there is that's the full total loss. So you get that call in the middle of the night. It's Aaron calling saying the house is gone. Everybody's safe, but hopefully, and the house is gone. You would receive the full market value at that point when that claim occurs on actual cash value. Deductibles still always applies, and the usual payout about 50 to 60% of what replacement cost would be. That's usual. Like I said in that roof example, it's going to be closer to 100%. But I have to average between all of the different payouts that we have. As Aaron said, one of the biggest things that are out there is just what is covered underneath my policy. I can't tell you how many times I see a policy that's on a basic form. They're getting a good price for it, but they don't know, the insured doesn't know what's covered and what's not covered. They just said, hey, he got me an insurance policy, good enough. There are all these intricacies in an insurance policy. There's actually, as you see, basic has DP1 or CP1 or basic one, and then special is DP3. There's actually one in the middle called broad. Nobody really provides that anymore, but but just wanted to point out that there is yet another one out there. You'll see basic a lot on a property that's vacant when you purchased it, meaning you're going to fix it up or you're going to get a tenant in there, but you just haven't got that yet. Well, that's great as long as they switch it to the special when there's a tenant in there. unfortunately, you don't see that a lot. Usually, you guys don't know to have it switched, so you don't ever have it switched over. So basic, the way it works is it says in the policy what is included. And it says fire, and there's a paragraph on what they mean by the definition of fire. And there's smoke, and there's a paragraph. And so it goes through and tells you what's covered. What most of you are used to on your homeowner's policy is a special form policy. Everything's covered, the direct physical loss is covered, except what we exclude. The exclusions on there, the two big ones that most people worry about are earthquake and flood. Those are just pretty much always excluded on a policy. Flood is almost 100% of the time excluded. Earthquake, you can usually buy it back unless you live in California or some other high earthquake state as far as that goes. And even there, they've done a good job of reforming the market and getting earthquake available to everybody. The big difference between the two, basic, the burden of proof, that's on you. They told you they cover fire, and we described how the fire is. Did that happen? If it did, great, you're covered. Whereas on special form, the burden of proof is on the insurance company. They have to prove what happened was excluded. So everything's covered unless they can prove it was excluded. Theft is the big thing that we see that happens that's an uncovered claim. Not with our policies, because we understand property investors and we understand that theft is something that's real and does happen. House goes vacant. It's tough for them, but it happens all the time. They go in and just take the copper out. With copper prices what they are, there's a huge incentive for them to go in and do that. And the copper is not even really the expensive part of the claim. It's that they ripped out every wall. It's that they ripped out every faucet. It's that they ripped everything apart to take care of that. So we want to make sure that theft is covered. The first column I have here is a homeowner's policy. That is only for the house that you live in. That could be your primary house if you have a vacation house, but it has to be a house that you primarily live in. So that one obviously not being used for your property investment. Dwelling fire, that's what, if you go to your personal insurer, that's what 95% of them are going to offer you. The big thing with a dwelling fire policy is that if the property is vacant, they put it on a basic form. It's written into the policy that it automatically does that. So even if they tell you it's a special form, if you go into that 100-page policy that we send you, page 83 will say, if this property is found vacant, we're on a basic form policy. And then some of them are even more mean, like we were talking about before. If this property is also vacant for 61 days or more, we cover nothing. You abandon the property. So those do exist. They hide it in that 100 pages that they send you, and that's just the way it is. By the way, my father, second generation at the office, he did an experiment when he first started. Not selling a lot of policies when you first start in insurance. You have some time on your hands. So he would take the policies that he would deliver. He would write in the margin, flip about halfway through, write in the margin, if you find this, I'll buy you a 6-pack of beer. He never got one call. And he did that on every policy for 3 years. He swears at least. So nobody ever found it. He knows nobody's reading it. The insurers know nobody's reading it. The only time it gets read is after a claim, and you go, that can't be, oh. and the adjuster points that out to you. So exactly that. Watch out for those dwelling fires. Unless it's just a tenant-occupied property and it's going to stay tenant-occupied, and if he moves out, you can get somebody in quickly, then a dwelling fire policy is great. Or getting one that's different than standard. If you get one that understands what you're trying to do, because just while I'm basing this, I have 400 different underwriters that have 400 different opinions on how these policies should be written. So each one has a little bit of a different endorsement, a different flavor, I guess. Insurance is certainly not as commoditized as the commercials want to make you feel it is. Commercial package policy. This one, you do get theft covered, but then, as I wrote right there, and it'll be the next slide, there's a vacancy condition, meaning it's not covered. There are some things that aren't covered once it's vacant for so long. So there's a problem there as well. Now, this may work really well for, as I put, it's great for a hold type property because that vacancy condition only kicks in at a certain amount of time. So then the last one there, renovators, builders risks. If any of you are planning a flip, call up any of you can call me, but you can call your insurance broker and ask for that policy by name, because that's the only one that'll fit the book for exactly what you want to do. It covers the existing dwelling. It also covers your renovation. It covers theft. It covers all the things that you're worried about when you're flipping a house. There's about 2 or 3 insurers that are offering it right now. It is a newer product. In insurance, anything in the last 20 years is a newer product. So this one certainly is a newer product. And yes, theft is covered throughout the duration, vacant or not. That's certainly something that's covered. Here's that bad old vacancy clause. As I write up there, this is the standard. Allstate, State Farm, and other insurers exclude all damages over 60 days old. They consider it abandoned, at least here in Indiana. They may have different policies in different jurisdictions. I can only go off the ones that I've personally read. So this where it says condition 6, this is the standard language, where they won't pay for losses of the things that happen to houses while there's nobody in it. So no vandalism, theft, water damage, building glass breakage. All that does get automatically excluded at 60 days. You can pay more money and have that moved to 90 or 120 or 180 days. My suggestion is get a great leasing agent and get somebody out there to get somebody back in before the 60 days. But that's, sometimes that doesn't happen. So there are buybacks against this, but this is certainly what's out there, what's in a normal policy. I guess what I want to get through is there's no one-size-fits-all solution in insurance for property investors. Well, until you get to Aaron's size of owning properties, and we did find him a one-size-fits-all solution. If you have over 25 properties, we can get you that same solution, but you have to be at that level before that underwriter will even talk about it.
We just had to go to Lloyd's of London to get it, right?
Yeah, only to London, but we did find it, where they wipe away the vacancy condition. They give him earthquake, they give him flood. It's just all on there. So when he goes to the auction house, buys the property, or I guess the city-county building, not the auction house, but buys the property on a tax sale, he doesn't have to be too concerned on is this in a flood zone and is it flooding right now. It's covered underneath his policy, but you have to have a certain size for the underwriters to even want to write those type of policies. Last one here, and this is the last slide I have before any questions. This is where I get the most questions at, and actually I need to flip these, Aaron, because I always like talking about liability first. Liability is a concern that I get from a lot of investors. Aaron can talk about it, I can too. It doesn't happen that often, but it's good to have a backup plan. There's a reason you're setting up LLCs. There's a reason that you purchase liability insurance for your policies. For the liability insurance, the biggest reason, so you set up this LLC, you've got this firewall between you and the actual liability that you would face personally. So when that lawsuit comes to that LLC, who's going to represent your LLC? Well, if you buy an insurance policy, the insurance company's lawyer. If not, your funds are going to pay for that lawyer. And a lot of times, well, especially in property investing, the cost of defense is always more than what the cost of the actual settlement is. I mean, the things that you see just on not a regular basis, what we might see 1 or 2 a year, Aaron, maybe. You might see somebody that slipped and fell on the sidewalk, and now they want some money. They're doing the shakedown of send me $5,000 and I'll make this go away. Well, the insurance company isn't just going to write that check, because in Indiana they don't have to. But a lawsuit's been filed, and so you have to respond, or your insurance company has to respond to that lawsuit. So they'll spend $3,000-$4,000 to tell that person we're paying you nothing. That's just the nature of our legal system, and that's all that's all you can do about it is purchase liability insurance. But even with all of Aaron's properties, with 5-6 years, I can only think of about 2 claims you've ever filed, and both of those where the people did it to themselves, just trying to get into your pockets.
Yeah.
So it was. So even with all his properties, the chances of it happening to you guys, I don't think are very likely. And you'll see that in the premium too. They don't charge a lot of money for liability coverage. Now going back to the top part, business income certainly can be covered. It's one of the neat things about real estate investment. You can go out and buy stocks with your money, and it'll pay dividends. But at any time, that board of directors can say, we're done paying dividends, and well, you just either sell your stock or you move on. With real estate investing, you can actually not only insure the asset, so the stock, you can also insure the cash flow, the dividends that come from it. So there's a fire at the house. Obviously, you're not going to get paid a lot of rent after it burnt down. They will pay you the rent during the reconstruction phase of the property. So
Hey,
that's
Derrick,
certainly something that's on there. Yeah.
If we were to just, out of curiosity's sake, if we were to waive the liability insurance on a typical Indiana landlord policy, what would the annual price difference be?
About $70.
Okay, so think about that. The insurance company is saying, and the coverage amount is
$1 million.
$1 million. So they're saying $6 a month, you get $1 million in liability insurance. Now why would an insurance company be willing to charge you $6 a month for $1 million in liability insurance if they were worried about you getting sued for liability? If they were worried about paying a claim for liability? Why would it be so cheap? Derrick, what would be an example of a really expensive insurance rider?
Well, flood's always.
So flood, or
Yeah, recently.
in Florida, the hurricane.
Oh, well, yeah, wind and things like that. Yeah, hurricane coverage. Yeah.
Or how much is earthquake rider in California a year?
Depends on the property. $100,000 property. Depends on where it is in California, but you'd see maybe 2,500 or so, depending on the property. And I don't do California every day.
So could you say that for $250 a month, you could get $200,000 or $300,000 in insurance in California for earthquake?
Right.
So think about that. Now, I lived in California for a long time. There was an earthquake there. Very few percentage of those houses, the millions of houses, made claims. But some math analytical actuary in the insurance company said, all right, if you want a couple $100,000 in California because you have earthquakes, that's going to cost you $250 a month.
And then 15% of your house has to be destroyed because there's a 15% deductible before they even pay $1.
Ooh. So it's even more expensive. Yet, if you want $1 million for liability, yeah, we never see those. So $7 a month, cool. See, what's interesting is you listen to an asset protection attorney. Liability, it's a big thing. You got to set up your entities this way, and we're going to charge you to do all this, and it's going to be this way, because there happened this one guy where he got completely screwed, right? Isn't that what they do? They create fear, and they tell you this story. My Cliff Notes experience has been that asset protection is, for the most part, an overcharge. It's just my personal Aaron Adams experience, okay? I'm not saying that the asset protection that you pay for or that maybe you paid for won't work. I'm not saying that. I'm not saying it was a waste of money. I'm not saying that either. You may be the one person, and you'll be happy. I'm just saying it as an investor who's done thousands of properties, I was like, man, we always talk about this liability insurance. I'm never getting sued, and I own a management company. It's Aaron Adams on 1,500 leases, and I don't get sued. So weird. Oh, well, the insurance companies know, because when they set a rate, they look at hundreds of thousands sample size. Does that make sense? So what does a smart investor do? They make decisions based on probability. The probability that you will spend thousands of dollars on carpet and paint is very high. Yes or no? The probability that you will spend thousands of dollars on attorney's fees for evictions if you own hundreds of properties is high. Sure. We filed 10 evictions this month, and it cost us over a couple $1,000, right? You have to deal in probabilities. It's like, we all joke about how people get, not joke about, we talk about, people get really scared on a plane, but what's the probability that you die in a plane? Much lower than you get behind the wheel of your car. So we have irrational fears. I think that asset protection is an irrational fear because most of you have never been sued. That's what I think. I think that if you take out divorces and car accidents, which is the most common litigation exposure that people have, very few of you have been party to a lawsuit or defendant in a lawsuit. Very few of you have. And so it becomes a chicken little thing that people discuss, right? Where they circle up and spin it around. And that people who want to charge you to provide asset protection play it up. Just my opinion. Now, to clarify, did Aaron Adams talk bad about asset protection? No. Just gave you his 2 cents about what he spends money on and what he doesn't. Do I have an S-Corp? Sure I do. Do I have a trust? Yes, I do. Do I use LLCs? Yes, I do. Do I buy properties in my own personal name? No, I don't. Do I pay an asset protection attorney? No, I don't. Do I pay attorneys? Yes, I pay them to do evictions for me. I pay them to review contracts for me. but I don't pay them to set up and tell me how to run all my books and my life. Interesting, isn't it? Is that direct and simple for you to understand? Okay? Now,
I didn't put all everything up there. It is a different situation. The problem is you're getting into a slippery slope, especially on duplexes, because is a duplex considered vacant when one side is vacant? Well, the traditional policy says 36.5% of the property. If more than that's occupied, it's considered occupied. So a duplex is, unless you've got some really weird, where it's a loft upstairs and then it's actually a main house downstairs or something like that. So yes and no. 36.5 is the magical percentage. So if at least that much is occupied, then they consider the whole property occupied. If less than that's occupied, it isn't. So you have a threeplex and it's all even and one of them's occupied, that's a vacant property actually. So that is actually a good point there.
Other questions?
Well, I'll pass out my business cards. Any questions that you have that are specific, feel free to email me. Even if you're not going to buy insurance from me, that's fine. I'll be glad to answer any questions you have about your policies, about what policies we provide, whatever we can do to just get the advice out there for you guys. I've got a whole pocket full of them. I'll make sure to pass them out as I leave here.
And when you buy from us, you'll get an email from Derrick. You'll get a
introduction and then
a letter from him saying, okay, it's on Aaron's insurance policy. He's selling it to you now. Do you want to get signed up with me? You'll get that from him. And you'll get that as part of the communication from our team as well. So you'll have a chance to maybe go to your State Farm guy and say, hey, let me see your landlord policy on this Indiana property, and then send it to Derrick and say, Derrick, what do you think? What's different from what Aaron usually does, and what's your take on it? Break this down for me. So, I really have a hierarchy of the power team in terms of how important they are to me. Okay? So probably number one, obviously, is my own staff, my employees. So my W-2s, my 1099s are the most important. They get the most of my attention. Then after that, I'd say it's probably bookkeeping and accounting. That's probably my second most important in the hierarchy. Insurances come next, title and personal, business, liability. You can skimp on a lot of things in business. You can skimp on the guys who paint your house and how much you pay for that. You can skimp on legal fees by setting up your own entities. You should never skimp on a few things. You should never skimp on roofers, for example. Never skimp on the roofing contractor. Never skimp on electricians. Never skimp on plumbing. Never skimp on insurance. Never skimp on toilet paper, ever. It is not worth it. Okay? You have to understand what the hierarchy and what the trade-offs are. For me, attorneys tend to be close to the bottom of priority on my power team. They do. Now, for me personally, because I do business a certain way, I know I have an individual who I used to work with for years. He lives in Texas. He has 2 in-house attorneys because he loves to sue people all the time. He has a lot of litigation going on. He's getting sued all the time. They're much higher up on his power team. But isn't that an extension of his own personal values and the way he does business? Sure it is. But for me, it's my staff, my accountants, my bookkeepers, then my insurance, then my attorneys come into play. Make sense? So Derrick is very important to what we do. Anytime we have a different modification of the kind of business that we do, I get in touch with him, which I have to call you this week about the hail roofing damage insurance we need, because I just threw $100,000 at these 2 brothers, so I got to circle back with him on that. But can you see the role and why I use an insurance broker? And you can use Derrick for any state that you're doing business in for all the kind of policies that I use. You could use him for your home and life and auto if you wanted to. And it's important that you understand that. I'm happy to have you use him, or at the very least, if you just want to use him for the policies that you get from properties with us, sure. He's part of my team. You can use him.